And welcome to this week's live ASX strategy session. Thank you again for joining me. Great to have you here. Great to be here with you. As always, we're going to be covering the ASX 200 today. We're going to have a look at the small ordinaries, go through gold, copper, uranium, lots of interesting things going on there. And I've also got a couple of interesting stocks for you to have a look at. We'll cover a bit later on. And then also we've got a bit of Q&A time as well. So we'll save all the questions for the back end and just focus on the usual flow to get us going. As always, everything we talk about today is general commentary only. Doesn't cater to your personal needs or anything like that. It's all general. So you got to get personal advice if you want anything specific to you. I'll just quickly put up the disclaimer because we're doing it live. It doesn't have the usual link that I'd have in the pre-recorded version. So that's the disclaimer, just going through the licensing and general advice and all that sort of thing. So you can pause that and have a closer look at that if need be. Okay, well, with all of that said, let's get over to this ASX 200. So there's the ASX 200 up on the screen, and look, wow, hasn't it been a few days, a big few days? It's been quite an extraordinary rally that we've seen. So last week we were talking about the potential for a bounce, some sort of a bounce, but the bounce that we've had has been far bigger than what I was expecting was going to far bigger than what I thought was possible or was likely. And so the situation we had last week when we were speaking was we had the ASX 200. It was quite stretched below these declining 50 and 100-day moving averages. And when you get a situation where prices stretch below averages, the averages tend to act a bit like an elastic band and the market snaps higher. And that's sort of been the way this price action has unfolded. Similar sort of situation in early October. Again, you can see the price got stretched and then we had that sharp kickback. Quite a similar kickback in early October to what we're seeing now. Now's is probably just a little bit stronger again. The Fibonacci's we used last week. Interesting just to line them up again. And you can see the ASX 200 is now at the upper end of the Fibonacci band and quickly closing in on the 50-day moving average. So the big question is where to from here. Was that a significant low point that we saw last week? And I think it's too early to say. We've had a 3-day rally. It's been a strong 3-day rally. It's been an encouraging 3-day rally, but it has only been 3 days. As it stands, the overall momentum from this July high, when you look at it in its entirety, it does remain to the downside. The ASX 200, it's still below these declining moving averages. So I think we still need to respect the possibility that this is a relief rally, a strong relief rally, albeit, but nonetheless, I think we need to respect the potential for this being a relief rally from a temporarily oversold position. It's not to say it can't develop into something more constructive, but it's just something that we need to be aware of. It can't be like, hey, look, the market's taken off, this is all good, because we don't have enough to go on just yet. I want to go over and have a look at the equal weighted. We haven't had a look at the ASX 200 equal weighted for a while. So this is it's an interesting one when you look at it. So it's weighting each company equally rather than the market cap version where the biggest companies have the most influence. And this has really struggled compared to the ASX 200 since the highs back in October 2021. It's been nowhere near as resilient as the ASX 200 because those big cap stocks have really done a lot of the stabilizing for the market as you go down through the tiers, through the into the 100 and outside the top 100. We can really see that those stocks have been weaker. And looking at this move from the July high coming down, and when you look at it, this really shows the magnitude of the weakness in the market, which is somewhat masked when you look at the ASX 200 market cap index. It has been a very weak period. has been very stretched below the moving averages, and at the moment, it's a snapback rally, which isn't enough for us to say, well, look, this is something bigger just yet. Markets can and they do bottom in this sort of way. But you can see when we look down through, like, looking at the low from June last year, the market rallied with a sharp decline and then sprang back. So markets can bottom like this, but we also need to be aware of other periods where let me just go. Let's have a look at this period from 2008, where this is the risk. I'm not saying this is what's going to happen, but it's what we need to, when we're managing risk, understanding possibilities, we need to be aware that we can get situations where the market does sell off, it does get stretched below the averages, it does have strong snapback rallies, but then it continues to decline before ultimately reaching a low. So I don't know at this stage where we are with this. But it's at the moment, it's about understanding the possibilities, just understanding where some of these risks could be. So going back to the ASX 200, I think the next week could be quite helpful. If the ASX 200 can hold on to most of these gains, start maybe trading sideways, building some sort of a base, well then maybe that can create a platform for another push to the top side. Another possibility which I've been looking at is, one possibility is that looking from the September low last year, we did see that strong rally into the February high earlier this year. One possible scenario is that this whole move over the last, 9 months is possibly a big zigzag correction. And if that were the case, well, then you would be looking at this being a significant low, and the market could make its way up for quite a big rally. Maybe it could end this whole sideways period that we've been through. That's just a possibility. It's not. It's look, I'd probably describe that as being a hopeful scenario at this stage, rather than one which I'd be thinking would be a base case. But it's look, it's just one of those things I'm looking at. I think the way I've been playing this so far has been to reduce risk on the decline as the market's been coming off. That's what I've been telling you through these videos. And I'll typically have my smallest position when the market ultimately reaches a low point. That's just how it will be. I won't have my biggest position at the low. I'll have my smallest position. And then it's the case of adding to risk as prices turn higher, as we start to get breakouts, as we start to get new momentum. And at the moment, there's not enough for me to say, look, I really want to start adding into positions. I have been reducing positions, and if we start getting some good momentum, I'll add to positions. And it's just worthwhile being aware of alternate possibilities that maybe there is a notable low in place. But as I always say, we've got to watch that price action and see how that plays out over the next week or so. And now I'm going to talk about the small ords and commodities. I'm going to get to that in a moment, but just first, I just want to tell you about how I'm going to be working these strategies going forward. So what we've seen so far, that's going to be what we've seen so far. That will be the typical free part of the YouTube service, which I put up, and you can get a gauge on what the ASX 200 is doing. What I'm going to be doing for the rest of the video, well, that's going to be part of a strategy session members service. And the reason I'm doing that is I've got to get some sort of return on my time. Unfortunately, YouTube doesn't really pay the way to make that investment of time worthwhile, but I want to make this a sustainable, ongoing resource for you. And to do that, the best way to do it is to make it a membership-based service. And I want to keep it low cost. I want to keep it as accessible to. I want to keep it accessible to everyone. But collectively, that small cost, which it will make the whole thing hopefully sustainable going forward. So you do get all this coverage of the commodities, of the interesting stocks, and lots of ideas, making it really valuable for you as a go-to resource. And so the way the pricing will work, if you're not a Motion Trader member, it's going to be $9.60 per week. And if you are a Motion Trader member, it's going to be $4.20 a week. And so another benefit of being a Motion Trader member, keeping that cost even lower. Now, if you're not a Motion Trader member, you're going to see a link just beneath this video. You'll see get the full session. Get the full strategy session in the description section. There's a link in there, and that will take you through to a page where you can register to get the big part with the commodities and the individual stocks from next week. This week will continue on in a moment. If you are a Motion Trader member, well, I'll send you an email with a link to a special page for you to get that discounted half price subscription to the strategy sessions. So look, hopefully that's going to be good and something interesting that you're going to be able to jump on with and stay with me through these, because I'd love to keep talking to you about all these things to do with the markets. Okay, so let's get back into our charts now. So calling this back up, what we're going to do now, we're going to go over and have a look at the small ordinaries, which has had a really interesting week. So jumping over to the small ordinaries. And so what's been interesting here is that during the week, the small ords broke to a three-year low, and we're now getting that strong rebound. And what is interesting to consider is, like, has this been a false break where market breaks below support, doesn't get followed through selling, and then rebounds? It's a bit early to call that at the moment, but that's the sort of thing which I'm considering. When I do look at this, though, this isn't a clear-cut support line that I have in place at the bottom, because you can see that back in October 22, it didn't actually stop there; it overshot. So I've drawn that in to give a nice visual on where the range has been, but it's not a strictly formatted trendline support. But what you can say is that each time the market has broken to a new low, so we had a low in June 22, made a new low in September 22, couldn't sustain that and started a substantial rally. We've got a new low now in October 23. So far, that hasn't been sustained. It's been another rejection of a break, and we've got a rally. So it's, again, I want to see how this price action plays out. But it is one scenario. It is a feasible scenario that we had that rally from the March 2020 low up to the high in October 21, and it's feasible that the whole correction does end here and now. I'm not saying that's what's happening. It's one of the possibilities which I'm entertaining. I think you've always got to keep an open mind with these things and look at the possibilities, explore the likelihood of them, and at least have some understanding of what could happen. So if prices starts to develop a certain way, you've got a head start on your thinking. So at the moment, we are below these declining moving averages. Got to respect that. But it is that point where I think for people who do like to try and get in early, and this isn't the strategy which I'm using myself, because I always say that the vulnerability is when you're below the moving averages, but it's then understanding when a market is stretched below averages, looking at the price action. For people who are really interested in trying to time a low, it does shape up as one of those potential asymmetric entry points. And the reason for that is the downside risk is clearly defined in that the downside risk is just beneath the current low. So if you were to measure that out at current levels in the small ords, downside risk is something like probably less than 5%. Upside, if this were a significant low, well, you go up to the top of the range is 10%, up to this overhead resistance is 15%. If things were to continue upwards, is 20% plus. Is it a high probability play? It's probably not a high probability because we're playing something below moving averages, but it's a possibility, and you can come up with an asymmetric, some asymmetric parameters to say, look, if I wanted to punt a low, that could be a way to do it. It also ties in with that scenario I was showing with the ASX 200, where you go, look, we had that rally from the lows last year. Has the last 9 months been a zigzag correction? it's possible. Again, I'm not playing either scenario, but it's always good to consider and be open to those alternate possibilities, because I think a lot of people just lock themselves in one way or the other. And there are people who have been adamant since the March 2020 low that the market had to crash again and has to crash again and will crash again. And they can hold those positions for years and be wrong for years, but just be steadfast in them and won't budge. I don't think that's the way to play. I think we need to be mentally flexible with the way we approach these markets, be guided by the price action, be guided by asymmetric possibilities, and try and manage risk around those. So let's move on to some commodities now. But first of all, look, if you're getting some value from this, please hit that like button. Very important. It makes a big difference to me if you hit the like button. And if you're watching the replay, you can't do this if you're watching live, but if you're watching the replay, please leave a comment. Just, hey, thanks for the video. Just shows YouTube people are watching. Then YouTube goes and shows other people. So that makes a big difference. So please do that. It helps me a lot. Now, let's jump over to the commodities, and we will start with gold. And really, it's similar to what I was saying last week. Gold seems to be losing its momentum, and that's been the case for pretty much the last 3 weeks now. And I think it's on the verge of a pullback. I've been saying over the last, I think it is the last couple of weeks that I think a move back towards these moving averages is probably quite a reasonable scenario, and I think that still remains the case. I'll jump over to, let's have a look at a 1 hourly chart, and when we see that, so what I want to look at in the 1 hourly chart, so the moving averages, when I jump to an hourly chart, the moving averages turn to 50 and 100 hours. So the duration of the average, or the units of the moving averages, will equate to the time that we're looking at. So we're looking at hourly charts, so it's 50 and 100 hour. And what we have here is the prices now, I was going to say it's struggling to stay above the averages, but really it's on the underneath side of the averages now. So we've gone from being clearly above during the trending phase, where the market started to stall, lose momentum. It's now shifted below the averages. So that puts some sort of vulnerability into the picture. And you could also say there's the possibility of some sort of a head and shoulders formation taking shape. So you could say there's a shoulder over here during late October. You got the head there in again late October into early November, and now we've possibly got the right shoulder forming. So then you can drawing the neckline, which goes in somewhere like that. It's not a terrific head and shoulders, but it's got that general look to it. Just going to change the color of the line. So it's got that head and shouldery look to it, if you like your chart patterns. But for me, it's more a case of looking at the moving averages. Price has gone from above to below. That means it brings in some vulnerability. And also when we go back to the daily chart, we're still stretched above the moving averages. So this would be quite a normal point to get some sort of consolidation. I think any sort of pullback towards moving averages would possibly be a good entry level, or a good level to add to positions. But at current levels, I just don't think this is an asymmetric time to be adding to gold. Interesting with the stocks. Just having a look at Newmont. We're talking about Newmont last week, and tentative positive signs starting to emerge. So last week I was outlining what a base could look like. So if the price were to track sideways, maybe for 2-3 weeks, and then start to break above the moving averages, start to break above resistance at 40, get above the averages, that'd be early positive signs that the stocks are starting to move in line with the gold price, because the stocks have been out of sync for pretty much all of this year. So that's tentatively positive for Newmont, and I'm seeing that across some of the other gold plays as well as the GDX Gold Miners Index. As I've been saying, I'm happy to keep holding my longer term gold positions, and I keep watching those opportunities. But it's looking encouraging. We're stabilising. The next thing is getting above these moving averages. So we'll keep an eye on that. Having a look at, let's have a look at copper. Copper. So copper, it's been a pretty quiet sort of week. It's been a pretty quiet couple of weeks really for copper. There's not really a lot of momentum either way. It's really just been grinding high towards these declining moving averages. I'm going to just clean this chart up a bit. I'm just going to take off these lines I've had from previous times, because I think the problem with leaving lines on charts, they're interesting from an education point of view to sort of like see how the patterns form and see how the price action responds out of them. But if you leave them there for too long, then you can miss other things because your eye's drawn to the past patterns. I'm going to also add in a trend line. So I'm just going to get that high from June and project that down, because we've got this other high from April and a high from August. And when we line the three up, they line up quite nicely. So it gives us a 3-point down trend line, something useful to look at. I looked at the possibility of saying, look, is this a trend channel? I just quickly put this in just to show you how it looked. And I thought, look, could we call that a trend channel? And it's just looking at this point around May, it just dips too far below it. It's a little bit, then that's too wide. That breaches it too much. So I thought, look, I won't use that lower line. I'll just run with the that top line. So that's a trend line worth watching for a turnaround copper. It's still got some work to do. Got to get above those averages. Averages need to cross. Got to get above the trend line. So there's a bit of work still going on in copper, but it's encouraging that it's lost a bit of its downward momentum at the moment. But it's still, for me, it's still not quite there yet. Having a look at the copper stocks is also another interesting thing. I think these are interesting to watch. At the moment, you'd say the path of least resistance is to the downside. We've had the selling, we're below the averages. The same old story. We've heard it all over the last few weeks, because that's just remained the play. What's interesting though is that when a market breaks down from a range, you get the initial move lower, you get a pause, and then what we had last week, or what we had, it was actually on Wednesday, market broke to a new low, but then on Thursday it's jumped back up, back within the range. So what I'm watching for now, and this is something possibly setting itself up. If there's no follow through selling after copper stocks have broken down from this big 9-month range, can't get follow through selling, then you look for the possibility: is this a false break? Does the price get back above the support where the breakdown point was? That's at around 34.50, and then back towards the averages. Then you start going, well, look, was that a false break? There's some of my favorite patterns: breaks from trading ranges that don't follow through. As I say, we're not there yet. Nothing to get excited about at this point, but it's something on the something there which is worth keeping an eye on, as well as in conjunction with what the copper price is doing. Jumping to uranium. So it's look, I've been saying in uranium for the last couple of weeks, I think it's getting close to a pause, and that remains the case. It's just looking sluggish. It's just been looking sluggish over the last couple of weeks. It's really, it's still stretched above these moving averages, both the 50 and the 100. And what I've also been looking at an RSI. So we put on an RSI, so a relative strength index. And what you see when we do this is there's a great deal of divergence going on, in that we have price making a new high, but then you come down to the RSI, and the RSI is it's a long way from making a new high. In fact, the RSI is look, you got that classic divergence, and just showing you how divergence has been useful in the past. Just this period during 2002, we had stocks making a new high, but the RSI not, and then that ultimately led to a period of quite a significant pullback. I'm not suggesting that's where we're heading, but I do think that the risks are mounting that some sort of pause and pullback is probably not that far away. I just find it hard to believe that uranium is going to keep going at the pace that it had been going. Most uranium stocks haven't made a new high above their levels from September. Although it is interesting because Cameco, this is a big Canadian producer, it actually has made a new high. So it's more in sync with uranium price than most of the other uranium plays that I've been looking at. I think maybe one of the reasons for this is the largest, most liquid of the uranium plays. So if there's going to be any institutional buying, this is probably where it's going to show up. Maybe that's something to do with why it's got more momentum than some of the than a lot of the smaller plays, like a lot of those ones we look at locally, like Boss Energy and Paladin, Bannerman, those sort of stocks which are below their highs. I don't think we're at an asymmetric entry point for uranium or the stocks. I don't think it's an asymmetric point to add to positions at this point. My take is that I think the near-term upside is probably limited. As I've been saying, I think that consolidation is coming. I'm still holding my uranium stocks, haven't sold. I'm taking that medium, longer-term view with these. I'm trying to hold them for a larger, bigger rally over maybe several years. But as always, be guided by the price actions. If it all completely deteriorates, I'll sell a lot. But that's not where we are at the moment. It's a case of staying with things which are working, but also thinking about where the risk of adding is maybe not so asymmetric. So let's have a look at a couple of stocks now. I'll get to some Q&A in a moment, but let's start with the stocks. And a couple of interesting things this week. I didn't talk about anything last week because I just didn't see the setups with the vulnerabilities that the market had been below those averages. But this week is a bit different. I'm going to start with Rio Tinto. So it's interesting. A few weeks ago, someone said, "Look, why are you always covering the smaller stocks? What about large stocks? Do you do those as well?" And the answer is, yeah. I'm looking. I pretty much look at everything, but I often talk about the small to mid caps because that's where I just like talking about stocks which most people have never heard of. I find them fascinating, the names which I've never heard of myself. And also in recent times, the big caps just haven't been giving too many interesting, or haven't been giving too many breakouts that I've thought looked encouraging. But Rio is a bit of a different story. So 45 billion market cap. It's the 11th largest stock on the ASX, just ahead of Telstra and Woolies. Dividends pretty attractive, 4.8%. According to the ASX, but one of the things with their dividend has been declining over the last couple of years. They haven't paid their special dividend out in the last period. I think a lot of that's to do with they've got cost pressures, commodity prices have come off, but nonetheless, 4.8. So it's a good, solid dividend payer. But for me, it's all, as you know, it's all about the price action. Now, this has been a motion trader stock for a couple of years, but I've just been going through looking at some of these iron ore plays, and it's now meeting the criteria for what would be a fresh entry point if it hadn't already previously been signalled. So I've got the 50 and the 100-day moving averages crossing, turning to the upside, and just out of this little, you can see just here we've got a nice little compression band. So that we've cycled from being below the averages to above, tracked sideways in a compression band, and now we're breaking to the top side, broken to a 70-day high, which is a trigger for a motion trader signal. And so I think Rio Tinto is looking good. It's I think it's one of the better looking ASX plays at the moment. And then you look at the stock, you just compress the price action a bit, and after this big rally during 2018, 19, and 20. Really, the stock in general has been going through a large sideways compression range. So maybe we're breaking out of a smaller range, which leads to a break from a larger range in the weeks and months ahead. So interesting stuff going on with Rio. And just quickly show you the iron ore price while we're talking about Rio, and it's look, it's got some positive structure to it as well. So big decline from the 21 high, bottomed out in October 22, rallied to the into February this year, and then over the last few months, it's really been a bit of a sideways grind. what we have now is we've got price above the 50 and 100-day moving averages, breaking to a new high above the September high. So there is some momentum coming back into iron ore. So where this goes, we don't know, but we do know that the path of least resistance is in the direction of the prevailing momentum, and that for iron ore seems to be the top side, and that seems to tie in nicely with the chart structure that we're seeing in Rio. And I'll show you the other stock I want to cover this week, and it's another iron ore stock. So keeping the theme to iron ore this week, it's a smaller play. It's Mount Gibson Iron. So this is market cap for Mount Gibson is about 640 million. So higher risk play than Rio naturally. It's really had a tough time since 2019, and really it has found support over the last couple of years down around this high 30 cents sort of region. And just on this stock, WA based, so it is an Australian based iron ore stock, and it's actually got a high dividend. Interesting, the dividend in this stock is quite high. So that can sometimes be the market factoring in risk that the dividend may not be sustainable. That said, though, we've had some success with some coal plays over the last couple of years, which have had high dividends and also had high capital gains as well, which followed on from that. So it's something to consider, something to look into if you're interested. Zooming in on the most recent price action. So this was a motion trader signal. Motion trader members will probably recognise this from Tuesday. Just as the moving averages crossed, just as price broke to a 70-day high, we got the entry signal. Entry signal was probably around 51 cents. So about 8% maybe below where price currently is. And we do have that upward momentum starting to creep in. Always a possibility these things consolidate a bit. Like anything I talk about here is it's not to suggest that the stock's going to go flying next week and be up at 70 cents or the equivalent to whatever the stock is before you know it. It's I'm looking at setups. I'm looking for possibilities. So this one here, I've got a stock which is coming off lows which have held, hasn't been able to break lower over the last couple of years. We've had a compression band over the last since June, so over the last 5 months. Now we've got a breakout, moving averages crossing. So that's the sort of setup that I want to look for, that I want to play and manage risk around. But of course, there's also the risk that a breakout fails, stock comes back. That's why we have exit strategies. I cover exit strategies in the Motion Trader service, not so much in the videos. And but it does meet that criteria for a stock with momentum, with the potential to continue upwards over the weeks and months ahead, notwithstanding the possibility for consolidation. Because of course, we've moved above moving averages. As I often say, stocks pause, let moving averages catch up, then rally again. How this one plays, we don't know. But look, some interesting things to have a look at. So we might start getting into some Q&A. And someone actually sent me an email through the week. I'm just going to start with one from through the week. I was just asked about a stock, ACF Arrow Formworks. And this is actually a Motion Trader stock, which has been in the portfolio for the last, where did it come into the portfolio? I think it came into the portfolio in September on this little break higher, September last year. So it's been there for a bit over a year. It's been in a nice upward trend, mostly staying above the 1,500-day moving averages, pulled back towards the averages in July, but then kicked higher again. Again, consolidating now, pulled back towards the moving averages. The trend in this stock remains up. It's actually one I've got in my own portfolio. I'm not sure where the Motion Trader stop loss is offhand, but it could be around where you can see the see the cursor, because I'm always giving these stocks room to move. And that's how we're able to see off this pullback early in the year. So this was a what was that? That was a 22% pullback. So a lot of people would struggle to see off a 22% pullback because they're getting out quickly as soon as there's any sign of weakness. But if you want to stay on these larger trends, you've got to give them room to move around so you can see off these pullbacks, these double-digit pullbacks which periodically come in. So when I say double-digit pullbacks, I'm not talking about sitting through a 50 or 60% pullback. That would be against the way I trade. That's just letting risk run amok. but it's sitting through 20, 30% pullbacks will often be commonplace within large trends. So where we are now with this, it's consolidating above the averages, trends up. I'm staying with the stock. There's no immediate sign that it's about to break down. That said, anything can break down at any time. But at the moment, it's I'll give it the benefit of the doubt that it regains strength off the averages. But let's see how that plays out. So now let's get into some stocks. So being asked about the S&P 500. Well, I'll cover the S&P 500 separately. I won't jump ahead and do that because I've got the separate S&P 500 video. So otherwise, I'll be doubling up on the S&P 500. So I'll get to that. So you'll get that video from tomorrow. I'm going to film that after this, but it'll be available tomorrow. Now, FND is another one. So Findy, I remember the name. It has been a motion trader stock. I'm not sure whether it still is. But it, let's see. Let's just have a look at this. Look, it looks like it's a low liquidity stock. Those moving averages have crossed. The momentum's to the upside. If I had this stock, I would continue holding this stock because I'd want to see where this momentum takes it. That said, we are stretched above the moving averages. So whenever that's the case, I think it's not an asymmetric point to enter or add to a position, because often, as we can see in November, quick move above the moving averages, it got stretched, it did pull back. Everything ultimately does come back to those moving averages, unless, of course, the stock's taken over. But if it keeps trading, it will come back to those moving averages at some point. So for me, this would be a hold, not a buy. And let's have a look at AEV. Now, this is I don't know what this does. It's a project in the Northern Territory, so it must be mining related. It's like when we compress the chart, it's one of those stocks which, like, it's come from great heights. Could even be a uranium stock, I'm guessing by where it's come from. There's been years and years of not been a few years of not doing a great deal. The moving averages haven't quite swung in a position for me. They're still down. We're above the averages, which is encouraging. It's not to cut it all short, it's not a play for me. It may be interesting for someone who's looking and who likes the fundamentals. We could say, look, there's some support around like 0.08 of a cent. Such a low price stock. There's some support there. So for someone who really wanted to get in, go with this short-term momentum, there's always a possibility of getting it at current levels, putting an exit stop below support. That would be one play. Another play is waiting for the moving averages. Not a stock that will appear in the motion trader signals because it's too small and it's too volatile. But yeah, look, it is interesting. Always interesting to scan and look for these stocks which almost nobody's looking at. Fortescue, FMG. I looked at this to talk about today, but I ran with the other two. I preferred the look of Rio, although this came close. You can see I've already got the lines marked on it because I was looking at it. I've had the strong run off the October low, this sideways consolidation. It's just typical. I was kind of talking a bit about this sort of structure in the ASX 200, where you got the zigzag, the run off the lows, the zigzag, and then the potential for it to rally. So you can see these structures I look at, they reoccur over and over again and in different situations. It's none of these patterns are unique. It's all just looking at the price action, and it's this chart eye you develop by just looking at a lot of charts over a lot of times. What looks like just lines everywhere to a lot of people actually start to make sense, and you see these recurring patterns. So where are we with Fortescue? Moving averages are trading higher. It looks like it's on the verge of breaking above this overhead resistance, which is coming in at around $23. I like that we've had the run up, the sideways consolidation. It does look that it sets itself up for a run, and that falls in sync with what we're seeing with the iron ore price itself, as well as Rio and Mount Gibson and across other. There was another iron ore miner, which came up in the motion trader signals through the week. Members will know which one that was. So there's look, interesting things going on in Fortescue and the space generally, I think. Let's have a look at LDX. So LDX must be this one here, Lumos Diagnostics. And this is like these are ones which you can never catch if you're using some sort of a disciplined approach around trying to bind a strength, because you can see this one gapped higher after being in this downtrend. So it was trading on its lows, and then the next day it's gapped high. So it's news related. So they're just so hard to get these moves. Stretched above moving averages, as you know, I don't want to play. Sure enough, it's pulled back towards the averages. That brings us to where we are now. So we've got rising averages, which is positive, but they do seem to be rolling over. Price is right back on the 100-day moving average. If it's a stock that somebody really liked from a fundamental perspective, it is a viable strategy to buy stocks as they pull back to rising moving averages. These moving averages starting to roll over, which makes me less comfortable, but nonetheless, they are still moving averages are still positive. They haven't crossed to the downside. Prices at the lower end. It's the sort of stock which maybe could be bought on a speculative basis with a close stop loss. Could really be done. Yeah, look, if it broke below the recent lows, you'd then start saying, well, look, now it's getting below moving averages, which are rolling over. And that wouldn't be, for me, that wouldn't be a great thing. I don't have a strong feel for it, but there is that strategy of buying a stock as it comes back to rising moving averages with a close risk management strategy. You'd say it's possibly asymmetric because your risk can be quite small compared to your upside if there's something going on. So Red 5, RED. What's the code for Red 5? Yep, it's red. Pretty easy. RED. This has been a motion trader signal before. I'm pretty sure it is. It still is. I think I may have actually seen this recently. Moving averages crossed in July, and the momentum's been good since July as well. It's just consolidating. Same old story. Moving averages stretched above the averages, consolidating, letting the averages catch up. So, as we were talking about with the diagnostic stock a moment ago, buying a stock which is rising above rising moving averages can be a nice play. Worked quite well in September. Whether this can pull back a little bit more, like looking at what we were talking about with gold, if gold were to come back towards its averages, you'd probably think Red 5 would maybe come back, maybe get amongst its averages as well. So maybe if I was playing the pullback scenario, I might give it a little bit more time. Maybe I'd place a buy order in case there was like a quick decline and then rally during the day. Maybe picking some up somewhere midway in the averages, but then also knowing that I'd need to think about like where my exit strategy would be in case it continued to follow through to the downside. That's where buying these dips can backfire sometimes, where the price continues to follow through. But overall, look, I like the look of it. Nice upward trend, and it fits with the gold story. MQG, so that would be Macquarie. And I think we looked at this last week and the price action wasn't looking great then. And it's, where are we now? Interesting day. Yeah, interesting today that it opened lower, given the strength in the markets overnight. It's look, it's from anyone wanting to speculate that this week's lows are significant lows and a bullish scenario is in the early stages of setting up. A straightforward play with Macquarie, given this is a large outside range day, whether if this price action is right, which I have no reason to believe it's not, but it's just not what I was expecting to see. You could, and this is the way I played the S&P 500 last year, when October last year. S&P broke lower in the morning, CPI results came out, market closed on the high. I bought the S&P the the next day and had my exit stop just below the previous low. So you play that, you go, look, is that asymmetric? You look at the current price action, what exit stop do I need? It's about 4%, 4.5%. Where could it go? Well, it could go back to new highs, so 32%. So it would stack up as an asymmetric entry, but you're always playing a higher risk game when you do that below declining moving averages. And this is, moving averages are declining. There's, nothing's changed there. This could be a temporary relief rally before the whole thing heads lower. So we don't know. As I said, we've had 3 positive days. It's not enough to go off. Moving along to EML. So we looked at, I won't spend long on EML because I looked at this. This is my stock of interest a couple of weeks ago. I was talking about that, come back to the moving averages, still looking interesting, rising moving averages. It's a motion trader stock. Look, I think it's stacking up as an opportunity. It looks like it's trying to break higher from a compression region, which brought it back to the averages. It has the potential to move higher, and risk can be managed. Santos, STO. So we'll just have time for just a few more because I want to wrap up within 50 minutes, or it just goes on and on for too long. Oil's been interesting because you listen to the media and they're talking about how oil should be going a whole lot higher towards $100, but that's not what you're seeing when you look at the charts. Santos is now below these moving averages. Look, you've got this overall upward momentum, but then you've got this big sideways consolidation that's been in place for over a year now. This could just be moving either side of the moving averages. It just doesn't look like a go-to stock at the moment. For me to get interested at this point, I'd like to see it break above its October high. So for me, I don't need to go there until we see break to the top side. I'm not interested in buying the dip at this point because it could be just part of a big sideways pattern which continues to unfold over several months. So I don't need to tie up capital in Santos at the moment, but I'd be interested if it breaks to a new high. AX1, what is that? This is has been a motion trader stock, so recognise the signal. So I'd say it has been, and we've had an exit in this, and at the moment it's the average is maybe it's one of those ones where well below the averages, it snapped back, got to the top side, pulled back to the averages. Now we're just waiting to see where to next. It's still consolidating. The averages are trying to turn higher. There's encouraging stuff with this stock, whether it's the rally, the pullback consolidation, establish another base and then start to turn higher again. It's certainly got that look to it. One of those ones where I'd be looking to buy into strength. I'd be waiting for the moving averages. That will be buying at a higher level. If I wanted to get in earlier, if I wanted to use shorter moving averages, there's a clear risk exit point below the recent low. That's one way to play it. But yeah, look, certainly a stock of interest. LYL, just quickly. So just two more stocks after this. So LYL, motion trader stock. I had this stock myself. I exited last week as the stock was breaking down. We're getting this rebound, but it's rebounding to declining moving averages. If I was holding it, what would I do if I was holding it? Like if you're holding a stock like this, there are two ways to play this. It's like one way would be to sell into the rebound because it's below the moving averages. So, sell the rally. It's below moving averages. The strategy is often sell the rallies. So that's the rally. That can help you get out. Alternative would be to give it to another way to play it. Could be to put a stop below the recent low. It is a low liquidity stock, so it's one of those stocks which is easy to sell when the market is rising. That's what I found when I was exiting my position. It has been in a great uptrend, but for me, the uptrend came back too far. I give it room to move, but there's a point where you got to say enough's enough. And for me, it got to that enough is enough point. So I'm more inclined to watch it here. TLX, second last stock, and pharmaceutical company. Yeah, look, I can't play this one. It's broken this was pretty sure this was a motion trader stock, and we got the exit when we got the breakdown. And so this is not a stock I want to play at the moment. Moving averages have crossed, they're declining, prices below. Maybe it stabilizes here, starts to form a base, starts to round high, and gets back above the averages, but that's a story for another day. It could also equally go sideways and then break lower again. So I don't want to play this one at the moment. And last one for the day, Flight Centre. And what has Flight Centre been doing? And again, below these declining moving averages, I don't want to play this at this point. I don't really want to try and I hate preempting lows because it's too easy to get preempt lows and be wrong. It's I'd rather buy into the strength. It's just not my play trying to pick the low points. With this, we're below those declining moving averages. I think there's just better opportunities elsewhere, or wait for it to stabilize and pay a bit more potentially, but get into something which then has a more concrete base and looks to be rounding higher than just going, look, maybe that's the low. I'm more inclined to do that sort of thing with an index rather than an individual stock. I just don't like those plays so much. But look, lots going on. It's a really it's a time where we're seeing sharp moves in either direction, and let's just keep watching that price action. It's all about managing risk at the moment. It's hard to have high confidence in anything when you're in a market which has been going sideways for so long and has been difficult. And you've seen your portfolio most likely giving back money. You see a 3-day rally. We want to be hopeful. Maybe this is a turn, and you can construct a scenario that it is a turning point, but there's just not enough yet to say it's high probability. It's a possibility. Let's watch that possibility. So look, thank you for joining me. It's been a pleasure having you with me, and look forward to coming back, talking to you again next week. Till then, bye for now.